Hello, I'm Sean Richards of Not a Yes Man's Economics, and my subject is the world central bank, the US Federal Reserve. It has a dual role. Obviously, the main one is for the US economy, but it also at times operates on a world level. For example, we've seen this in the COVID-19 pandemic with the foreign exchange liquidity swaps that grew at their peak to nearly 450 billion US dollars as the Fed operated as the world's central bank. In the upcoming meeting, though, I think its concerns are going to be a lot more domestic, partly because the demand for the swaps I just mentioned is about a quarter of what it was now at the peak, and the numbers declining. But if we look at the situation in the US, there's still a lot of question marks about the economy, how much it shrunk, how it can rebound with the coronavirus issue, in some states still quite an issue. And of course, then if we look at the policies, quite a few of these have been deployed. For example, if we look at interest rates, it wasn't so long ago, a couple of years at the most, the US Federal Reserve was pointing to an era of 3% or more. But there's been something like a general Custer reverse at Little Bighorn because interest rates are now effectively zero, and it finds itself at times talking about negative interest rates. If we move to the US dollar, that's something that's in its favor. Recently, that's weakened. If you look at the dollar index, by somewhere around 10%, obviously this varies against different currencies. Now that'll be a boost to the economy. When he was vice chair, Stanley Fischer gave a speech on this subject, and he thought that move would boost the economy by somewhere around 1.5% over a period of, say, 2 or 3 years. So that's a reasonable amount, although of course compared to the pandemic, that's quite small. When he gave the speech, relatively it was a much bigger deal than what we're facing now. If we move on to the area whereby I am expecting some change, if not actually an announcement, a beginning of a sort of shuffling of the tectonic plates, is the amount of bond buying, what's called QE or quantitative easing, that the US Federal Reserve does. Why? Well, one factor is that they're looking at a name change, yield curve control. That normally indicates something like that. Although there's a hint in that it's not really work, because if you don't change the name on things that are working, do you? You know, Liverpool Football Club's not going to change its name, is it? Things are going well. Now, if we look at that, currently, the US Federal Reserve is buying $80 billion a month. But if we look at the spending plans of the US government, seems like the Republicans have a new plan of around about $1 trillion. The Democrats are suggesting $3 trillion. Now, at a time when we're running into an election, the numbers are likely to drift higher. I don't mean 3 trillion by that. I mean perhaps more than the 1 trillion, because the actual normal lines of resistance ahead of an election aren't there. Which means if the US Federal Reserve wants to keep bond yields low, and I believe it does, then 80 billion a month suddenly looks rather small compared to the spending. We were facing a period here, because America had borrowed a lot before, that it wouldn't necessarily be issuing a lot of bonds through this period. That was the story. But that is changing, because if they look to spend more, they'll need to borrow more. People look ahead. The pitch can change quite a bit here. So that's the area I'm expecting a sort of shuffling and something of a change. They don't have to announce this sort of thing at a policy meeting, but I rather suspect we'll get hints in that area, because there's not a lot really left for them to do otherwise. There's talk of things like forward guidance, but let's face it, who believes they're going to raise interest rates anyway? So to summarize, quantitative easing, more bond buying, looks as if it's on the cards. If not today, then in the future. Thank you.